And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. It's our last show of the year. Can you believe it? A whole year. And all week long, we've been asking our guests to tell us which ETFs they think mattered most in 2019, which ones could break out in 2020, and the ETF of the decade. Let's start with 2019's ETF of the year. Not necessarily the best performers, but the ones that had the biggest impact on the ETF industry. Here's what some of our recent guests have said so far. Bonds, home construction, semiconductors, and ESG stand out as major themes here. Joining me today to discuss 2019 ETFs, Jay Jacobs, head of research and strategy at Global X ETFs. John Davi is the founder and CIO of Astoria Portfolio Advisors, and Brendan Ahern, CIO of KraneShares. And Jay, your pick for 2019 semiconductors, we've had several times people pick that. Why SMH? Again, that's the semiconductor ETF.
I think this was a great example of using an ETF to play a very powerful macro trend, which was the US-China trade wars. Anything semiconductor related or tech hardware related really became, the daily way of playing that trade. And of course, heading into 2019, people were very bearish on the space. It turned out to be not as bad as expected. That led to very strong performance across semiconductors, across China technology stocks, and across Internet of Things, consumer electronics.
Hard not to argue tech, again, dominating things. But John, as usual, you come up with an unusual choice. IHDG. This is Wisdom Tree International Hedge Dividend Growth. Why international and why dividend growth?
Okay, so, if you told me at the start of the year that a broad-based developed international market would have been up 34%, I think most people would be surprised by that. But it is the best performing broad-based EFA type ETF, okay? It does hedge out the currency, and we can talk about why I think that's important. But look, the bottom line is that it beat its benchmark by 1,200 basis point year to date, and it beat the S&P 500 by 400 basis points.
But that doesn't necessarily mean it's going to outperform next year. We know that. Just because it did well this year, we know the future. Future does not necessarily immediately follow what the past has done. That's an axiom, of course.
Over the last 10 years, though, broadly speaking, U.S. has really outperformed the rest of the world. So I think that this will do well in the years to come.
And why dividend? Why dividend growth? Why is that an important aspect here?
There's two quantitative screens, right? One is it picks high quality stocks. So you've asked a number of times, what does quality mean? So specifically, it's companies that have above average ROE and ROA. Okay, that's how they define quality. And the other half is companies with above average earnings growth.
Yeah.
So to me, that's very intuitive. You're picking high quality stocks that grow their earnings.
And Brendan, you're the China expert here, not surprisingly. You pick a China ETF, happens to be one of your own, but this is KBA, the China A shares. A shares is mainland China. It's done well this year. We're up 30%, right? Why is it going to outperform or why do you think it was the most important one for 2019?
Well, I think in general, who would have thought China would be one of the best performing, in contention to be the best performing country globally? This is a trade war. KBA represents MSCI's definition of Chinese A shares going into their indices. And one that's led to about $50 billion worth of inflows year to date via the Stock Connect program. So this is foreigners are buying mainland China, MSCI inclusion. At the same time, it's what Chinese investors believe what China is going to do going forward. Their view, their opinion of their economy, much more optimistic, much more positive, and I think those are two trends that will continue. The MSCI inclusion and Chinese investors believing the local economy is doing well.
We're going to talk more about China in just a minute, but I want to move on here. Which ETFs should we expect to break out in 2020? Now we're talking about the future. Here's what our other guests have been saying. Looks like they're expecting a return to quality, continued strength in the emerging markets, and a bit of a contrarian call for oil services to bounce back. That's OIH there. Love that one. Jay, your thoughts here. You're interested in infrastructure.
Well, let's go back to 2019. This was a year with very little earnings, and so what moved the markets was sentiment and policy, mostly the trade war. Heading into 2020, I think that's going to continue. There's very little earnings, and so people are going to be trading on sentiment and policy. The policy that's going to be in the spotlight is when Republicans and Democrats are debating infrastructure during the elections. It's one of the rare instances of consensus across the aisle. It's an area that needs huge investment, and we think we can make a lot of progress in 2020.
And PAVE is what you want to put up here. That is the infrastructure ETF. Doesn't have a lot of assets, but you think you can gather more as this becomes a real issue. Do you think an infrastructure stimulus bill could actually pass?
I think it's very likely that we could see progress towards an infrastructure bill. We've seen Trump float $1 trillion bill. We've seen Biden float a $1.3 trillion policy. So our ETF, PAVE, is not looking at existing infrastructure. It's the builders of new infrastructure.
And John, emerging markets, this makes some sense. If the dollar continues to weaken, it's done well so far this year. I'm talking about EEM here, the main emerging market ETF.
Yeah, so I didn't pick IHDG again because your point that, is it going to print another 34% rally? Probably not. But EEM, if you look on a one-year basis, it's up about 6 or 7. EFA is about 12. S&P is up 16. So I think emerging markets have a big catch-up trade. It's cheaper than EFA, cheaper than the U.S. So you've got some of these catalysts are out of the way. You've got a resolution with U.S. and China trade war. Fed's on hold. So I like EM a lot.
And you're sticking with China still. You're going with the all China KraneShares. That's KALL is the symbol there.
Yeah, I mean, much as like John just articulated, I like EM, but the problem with broad-based EM is it's all old sectors, all old economy. It's 50% value. That's why I think broad-based EM has lagged the S&P 500 for the last decade. We're in a growth market, and the broad-based EM is a value play, so break out the growth part. So that's our view for next year.
Okay, let's move on here and talk about the end of 2019, which marks the end of the decade. So we've been asking our panelists to pick the top ETFs for the last 10 years. Again, it's not the biggest winners necessarily, what's gained the most. It's the ones that have generated the most buzz or changed the ETF landscape in some major way. And they didn't have to be around the whole time, by the way. So we have our recent guest picks here, European equities and Vanguard's bet on the broad market. That's VTI, total stock market, stood out to them. I know you guys have some thoughts on this. Jay, your vote.
My vote for the last decade is XLK, technology sector. Technology was the difference between an outperforming portfolio and an underperforming portfolio. So you saw a lot of asset managers allocating towards high growth technology stocks. We saw how important the FANGs were in contributing to the growth of the S&P 500. It made all the world the difference.
Hard to argue with technology. John, again, an unusual choice.
Yeah, well, that's what we do, right? We pick unusual ETFs. Look, if you told me 10 years ago that the iShares minimum volatility ETF, the ticker USMV, that would have garnered $35 billion in assets, I would have bet money against that. But what it does is it picks a basket of about 200 stocks. It optimizes against low correlation, low volatility stocks against the broader market. Over the last 10 years, it's had better risk-adjusted returns versus the S&P. And so it has like some built-in protection.
And it doesn't bother you, you're not getting any real growth here. You're owning Pepsi and Coke and utilities. That's the problem I have with it. I know it worked in the middle of the year because people were concerned that the global growth was going to slow down dramatically. But really, I mean...
So compound annual growth for the S&P over the last 10 years is 14.6%. Compound annual growth for USMV is 14.40. So I mean, it's very, very close to S&P. You just don't have as much downside risk as the S&P.
And of course, Brendan, you were talking about S&P 500 ETFs.
Yeah, I mean,
your vote for the decade.
For the past decade, I mean, there's been one game in town, which has been U.S. large cap. The more you've diversified, the worse you've done. So certainly for the past decade, anything but the S&P 500 has led to lagging, outside of breaking out, say, tech. Because we've been in this growth market.
I'd have to agree with you. My vote for the ETF of the decade that had the most impact would be the S&P 500, SPY, IVV, VOO, those types. If you were 10 years ago, the public still wasn't terribly widely versed in investing in ETFs in general, and even in the concept of buying a single stock that represented essentially most of the U.S. stock market. And I think the public now is very used to that. And in terms of impact, it's hard to argue about the S&P 500 funds in general.
Those three ETFs are three of the four largest globally. So I just think just by pure definition of investor interest.
I'll vote with you on that one. Finally, China's been a huge theme this year with the trade war and global growth concerns always top of mind for investors. Brendan, your firm runs a suite of China-focused ETFs. What should we be expecting from the world's second largest economy in 2020?
Well, with one, from just an economic perspective, the trade war has been an inhibitor to growth. The consumption side of China is alive and well, as evidenced by Singles Day, by U.S. multinationals doing business. So I think as the cloud goes away, you're going to see investors come back into the China equity market in a big way. We're already seeing that. We talk about these northbound inflows. It's happening.
I think what's important here is to X out the trade wars. I know China is an exporting company, but if you look at the Chinese consumer stocks in China did did well this year. Even with a slower market, not contracting, but slower market, the Chinese consumer did well. And just like consumers here in the United States are healthy, the China consumer is continuing to buy. And I think people need to understand that aspect of it.
That's very much true, that the Chinese consumer is alive and well. How they transact is it occurs online. They're leapfrogging over the big box retailer, big box mall. It's happening online. That's what we want to hold.
I want to point out to our viewers, we have done this many times, know the ETF that you own, how different the performance is among some of the major China ETFs this year. I'm wondering if we can just put this up because it's really rather startling, and much of this depends on Hong Kong here. So here's your fiefdom. Brendan, KraneShares, you control these, up 33%. That KBA, that is a mainland China ETF. You own stocks on the mainland. The second one, KWEB, you own mainland stocks. These are internet stocks, but you also own stocks here in the United States, Chinese stocks that list here. You'll still see good performance, up 29%, not quite as much. The broadest one, MCHI, the one I like, that has mainland China stocks, U.S. China stocks, and Hong Kong. And finally, there's that last one, FXI, which only has Hong Kong, only up 10%. My point here is Hong Kong killed the performance of a good part of these ETFs, and the ones that didn't have Hong Kong in them, like KBA and KWEB, outperformed the market.
Yeah, I mean, certainly the sentiment around Hong Kong is very poor at the moment. It's hard to see a positive catalyst for the local economy. But mainland China, they have a very positive view at their economy, and at the same time, that consumption story as it takes place online, KWEB holds those companies that are the transmission engine. So we're very positive for both of these trends going forward.
Let me ask you about China ETFs, and guys, feel free to jump in if you want, but we saw Alibaba do a secondary listing in Hong Kong, which was very successful. I say successful. What's the standard for success? Well, the minute they announced it a few months ago, the stock price started moving up, and they had a very small float over in Hong Kong, essentially 2% of the market cap, and helped move the stock up. That's a pretty successful IPO. You have a small float in a secondary market, and the stock moves up because you've got how many Alibaba users are there? 600 million, maybe, in China?
Well, I mean, look at Singles Day, $38 billion worth of sales in 24 hours. But it's not just a Baba story. JD did over $20 billion. Pinduoduo, we believe, did over $20 billion. So it's a consumption story.
Here's my question. If the trade war turns south again, we saw China IPOs listed here generally did not do very well. Luckin Coffee did very well, but that was an exception. Most of them didn't do very well. Part of it was on China economy, a bit slower. Part of it was on the trade wars. Part of it may have been a little tougher regulations, but do you see any possibility that more Chinese companies may simply decide to stay over there and raise money in Hong Kong, for example, rather than come to the United States if things keep getting, if the trade war doesn't cool down at all?
So one reason Alibaba went and listed in Hong Kong was because, one, the local investors know Alibaba has nothing to do with the trade war. It has no revenue here. It's growing like gangbusters, and yet investors, because it has China name, didn't want to hold it. So they're going to where it's going to get more properly valued. Second, Southbound Connect. Baba will go into Southbound Connect next year. I think that's a major catalyst for the stock.
Southbound Connect meaning from China to
So mainland China still can't buy the Hong Kong listing. That will happen probably in Q1 of next year. Big move once that happens.
Okay. Fascinating discussion. Thanks very much, guys. Appreciate it. And that does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Jay and John and Brendan for joining us today. Thank you for watching and for your support throughout the year. We do appreciate it. We love talking about ETFs, and we love our viewers. This is our last show of 2019, but you can find all of our latest videos right there on our website, etfedge.cnbc.com. We're going to see you in 2020. Have a great holiday season.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.